Well, let's ask one of this country's top financial advisors. He is Richard Saperstein. He's the founding principal and CIO of Hightower Treasury Partners. He's with us here on set. How you doing? Good to see you.
Really good, thank you.
You must be feeling pretty good about the market, a day or here, a day there notwithstanding, because what's notable to me is you're trimming some of what you had in munis, which you've been a huge fan of for, gosh, feels like years now, and you're increasing your stock allocations. Tell me more.
These dislocations present opportunities for clients who don't have enough exposure to technology broadly. So let's look at the hyperscalers, 4 of them, Google, Meta, Amazon, and Microsoft. Their cash flows are increasing at an increasing rate. The market now is pricing free cash flow, not operating cash flow. So the market is saying, hey, you've got this huge operating cash flow. We don't want you reinvesting it back into the business, in spite of the fact that you have constraints on allocating space. They're starting to allocate space to their primary services, their first-party services, versus third-party services. This is a good problem to have.
So you're undeterred by all of these huge numbers because you may be, but the market obviously is not.
Well, what's the company going to do with their operating cash flow? They're going to either buy back stock, pay dividends, or reinvest back into business, or put it on the balance sheet at 3.5%. I'm voting that they're making the right decision due to the capacity constraints they have. They're making conscious allocations of that with that capital.
I mean, when you look at, you ticked off Google, Meta, Amazon, Microsoft. Let's take Amazon. We're going to have the first 8-day losing streak in that stock in many years, since like 2018, 2019. The stock did nothing last year. So what doesn't the market see? What's it not comfortable with?
If you're a short-term investor right now, you want to be in the non-tech names for the most part. If you're a long-term investor, you want to use this opportunity to add to some of these names. They're just building their infrastructure out for returns down the road. And the key to follow all this is the operating cash flow. If these stocks were going up and the OCF was not, then I'd be concerned. But the OCF is rising year over year over year, and they're plowing it back into the business. So if we have patience, we own these stocks for the long term. That being said, if we really want performance now, and we own oil, pharma, bank, we want to diversify consumer into those sectors for more near-term performance. Josh, he has a great, the halo thing.
Right.
He said that, okay? So for short-term performance, that's where you go.
But as you've learned, they're not all created equal, all of these mega caps. They're all having some issues in some respects. I mean, Microsoft, that stock, look at that today. That stock's ugly. Now, software's in the crosshairs. Do you think the software sell-off's overdone?
Yes. So with software, investors should look at IGV, the ETF.
And let me note real quick. Hey, guys, we'll go back to Microsoft for a minute because that's helped the Dow get off the mat, helped the market come back a little bit. No, today. Yeah, there you go. So earlier during halftime, we look at it, it's getting creamed, and then it slowly worked its way back. To your point about dislocations creating opportunities, others believe in that clearly.
This stock will be higher in the next 1 to 3 years, much higher. And I wouldn't be selling, I'd be adding to the name right here, because these companies have domain expertise, the software group. And what they're going to do is adopt AI and remain in the pole position in many of these companies. The market is discounting an outcome worse than is likely anticipated. Look at the operating cash flows of ServiceNow, CRM, all these companies. It's going up as these prices of the stocks go down, becoming more attractive.
You own those? You own CRM and ServiceNow?
No, I own IGV.
Would you buy the individual names?
Not
See,
right
that's
now.
dangerous buying the whole IGV, because then you're lumping everything in a boat that's taking on a lot of water, rather than being tactically selective in ones that may not be dislocated as much by AI.
I'm selective in the larger cap companies, but I'm taking a broad approach with the software companies. Think about this. If you look at the hyperscalers right now, I want to just go back to that for 1 second.
Sure.
The operating cash flow of the hyperscalers right now, the 4 I mentioned, is greater than that of the S&P, the non-496 names. It's an amazing statistic showing the relative attractiveness of the 4 stocks I mentioned versus the S&P.
What about the idea that we are witnessing, as some say, like Piper Sandler today, what they call a passing of the torch? And you have intensifying sector rotations. Capital is moving from growth to cyclical to value. That's why other parts of the market are more in favor than tech right now.
Short term, it makes sense.
Just short term.
Yeah, but in the long term, do I want to own a company that has a higher growth element, higher cash flow, higher margin than consumer products company that has lower of each of the above? In the long run, I want to choose the one that's growing the most with the highest margins and the highest percentage of cash flow.
All right. Stay with us.